In the 1920s, one man controlled the world's match industry. Governments trusted him. Banks financed him. Investors admired him. He promised stability. He promised guaranteed returns. He promised modern financial innovation. Billions flowed into his empire. This was not just corporate expansion. It was one of the largest corporate bond scams in modern history. Through monopolies and high-yield securities, he built a financial empire across continents. When the illusion collapsed in 1932, global markets trembled. Balance sheets unraveled. This was the rise and fall of the Match King. The First World War ended in 1918, but Europe did not return to financial stability. Governments emerged with enormous war debts. Currencies had been weakened by inflation and monetary expansion. Reparations reshaped continental finance. Germany faced heavy obligations under the Treaty of Versailles. France and Britain carried large borrowing burdens. Eastern European states were newly formed and fiscally fragile. Reconstruction required immediate capital. Railways, utilities, and infrastructure demanded funding. Tax bases had been eroded by war. Domestic savings were insufficient. Political instability complicated fiscal reform. Hyperinflation struck Germany in 1923. Other nations experienced currency depreciation. Confidence in sovereign finance weakened, yet governments still needed access to credit. American capital markets became increasingly important. New York emerged as a global financial center during the 1920s. Investors sought higher returns than domestic bonds offered. European governments required loans to stabilize currencies. Private intermediaries bridged this gap. Financial engineers structured cross-border borrowing. Monopoly concessions became bargaining tools. State-controlled industries were leveraged for financing. Infrastructure rights were exchanged for capital. This environment rewarded intermediaries who could mobilize funds quickly. Speed was valued over transparency. Stability was marketed as innovation. Guaranteed returns appeared attractive during uncertainty. Investors preferred fixed-income instruments. Corporate bonds gained popularity. Trust depended heavily on reputation. Regulatory oversight of international securities was limited. Disclosure standards were inconsistent. Holding company structures grew more complex. Cross-border subsidiaries obscured financial clarity. The interwar system was interconnected but fragile. Credit expansion supported apparent recovery. Stock markets rose through much of the 1920s. Optimism masked structural imbalance. Sovereign borrowers depended on continuous refinancing. Bond investors depended on steady coupon payments. The arrangement required uninterrupted confidence. Financial architecture favored expansion. Leverage increased quietly. Political leaders welcomed private financiers who could deliver capital. Desperation for stability reduced scrutiny. Reconstruction needs created opportunity. The post-war environment was not stable. It was vulnerable. This vulnerability created space for large-scale financial innovation. It also created space for deception. Ivar Kreuger was born in Sweden in 1880. He trained as a civil engineer. Early in his career, he worked in the United States. He studied modern construction techniques. He returned to Sweden with technical credibility. In 1908, he co-founded the construction firm Kreuger and Toll. The company specialized in reinforced concrete projects. It secured major infrastructure contracts. Its early success established financial trust. Kreuger developed relationships with banks and industrial leaders. He understood capital markets as well as engineering. By the early 1920s, he shifted focus toward matches. Matches were a universal consumer product. Demand was stable across economic cycles. Production costs were predictable. Governments often regulated match manufacturing. In some countries, it was treated as a state-controlled industry. Kreuger recognized opportunity in consolidation. He began acquiring match companies across Europe. He pursued exclusive national monopolies. The strategy relied on offering loans to governments. In exchange, governments granted monopoly rights. These agreements secured predictable revenue streams. The model combined industrial control with sovereign finance. By the mid-1920s, Kreuger controlled large portions of global match production. He negotiated with countries including Poland, France, Germany, and several in Latin America. The structure appeared mutually beneficial. Governments received immediate funding. Kreuger secured long-term cash flow. The arrangement enhanced his reputation. He was presented as a stabilizing financier. Swedish financial institutions supported expansion. International banks participated in syndications. Kreuger cultivated an image of discipline and reliability. His companies issued securities internationally. American investors purchased Kreuger bonds. The empire expanded through holding companies. Ownership layers increased. Control remained centralized. Financial reporting grew more complex, yet profitability appeared consistent. The monopoly model suggested predictable earnings. State partnerships reinforced legitimacy. Kreuger's transition from engineer to financier was complete. His credibility was no longer technical, it was financial. The foundation of trust had been established. This trust would later serve as collateral. Kreuger's expansion strategy centered on national monopolies. Matches were essential consumer goods. Governments often taxed or regulated their sale. Control over match production offered reliable revenue. Kreuger proposed a simple exchange. He would lend money to a government. In return, he would receive exclusive rights to manufacture and sell matches. The loans were typically long-term. Interest rates were attractive compared to other borrowing options. For financially strained governments, the proposal was compelling. Immediate liquidity outweighed long-term revenue concessions. The monopoly contracts often extended for decades. In some cases, the state guaranteed minimum consumption levels. This created appearance of stable future income. Kreuger consolidated production under Swedish Match and affiliated entities. Profits from monopoly markets supported further lending. The structure linked industrial control with sovereign finance. Each new agreement increased scale. Each agreement also increased exposure. By the late 1920s, Kreuger's network spanned Europe and parts of Latin America. Countries including Poland, Hungary, Romania, Greece, and Bolivia entered agreements. The loans varied in size, but collectively reached hundreds of millions of dollars. Revenue projections assumed continued monopoly enforcement. Governments were expected to suppress domestic competition. The model depended on political stability. It also depended on continued consumer demand. Bond investors viewed monopoly rights as secure collateral. The connection to sovereign governments reduced perceived risk. Political partnerships substituted for transparency. Kreuger's companies presented consolidated financial statements. Underlying contracts were complex and sometimes opaque. Cash flow assumptions were optimistic. New borrowing financed earlier obligations. Expansion created impression of strength. Scale became evidence of stability. The monopoly model functioned as both industrial strategy and financial leverage. It tied national budgets to private capital. It concentrated power within Kreuger's holding companies. The structure rewarded growth. It also amplified systemic dependency. The more countries entered agreements, the more credible the system appeared. The credibility masked increasing leverage. The empire was built on exclusive rights. It was financed through international bonds. The two were inseparable. Monopoly agreements were presented as security. In practice, they were commitments layered on top of debt. The model expanded rapidly. Its fragility remained concealed. Kreuger's most powerful instrument was not the match factory. It was the bond. During the 1920s, fixed-income securities were highly attractive. Investors sought predictable returns in uncertain markets. Kreuger offered corporate bonds with relatively high fixed yields. Some issues promised returns near 7%. At a time when sovereign bonds yielded less, the difference was significant. The securities were marketed as stable. They were backed by monopoly revenues. They were distributed internationally. American investment banks underwrote several offerings. Kreuger and Toll securities were listed in New York. European investors also subscribed heavily. The bonds were often structured through holding companies. Subsidiaries issued debt guaranteed by parent entities. Cross-guarantees increased apparent security. The complexity reduced clarity. Coupon payments were made reliably during expansion. Regular payments reinforced trust. Investors interpreted punctuality as proof of strength. Proceeds from new bonds financed government loans. They also supported acquisition of additional monopolies. Expansion and borrowing reinforced each other. Kreuger introduced innovative instruments. Some securities combined equity-like participation with bond characteristics. Others were structured as debentures without clear asset backing. Disclosure standards in the 1920s were limited. Audited financial statements were not uniformly required. International offerings faced inconsistent regulation. Complexity discouraged detailed analysis. Reputation filled the gap. The scale of the empire suggested resilience. Bond buyers relied on brand rather than balance sheet transparency. Yield premium justified perceived risk. During bull markets, appetite for high-yield bonds expanded. Demand enabled larger issuances. Outstanding securities eventually reached billions of Swedish kroners. Estimates suggest total obligations exceeded several $billion equivalent. Leverage increased quietly. Holding companies interlocked assets and liabilities. Cash flow from monopolies covered some obligations. Other obligations depended on continued refinancing. As long as markets were liquid, the structure functioned. Credit availability sustained the structure. The bond innovation appeared modern. It was marketed as efficient global finance. In practice, it substituted engineering for transparency. The architecture depended on constant access to capital. When capital tightened, the structure would be tested. For now, investors received coupons. Stability appeared intact. The bond became the centerpiece of the empire. Beneath the bond offerings, Kreuger's empire relied on intricate accounting structures. The corporate network consisted of numerous holding companies. Ownership layers extended across Sweden, Germany, France, and the United States. Financial statements were consolidated selectively. Intercompany transactions obscured true leverage. Loans between subsidiaries were recorded as assets. Guarantees were not always clearly disclosed. Cash positions were difficult to verify independently. Reported profits appeared consistent and stable. Dividend payments reinforced the perception of strength. However, underlying cash generation varied. Some monopoly agreements did not produce expected revenue. Government borrowers occasionally delayed payments. New bond issuances bridged cash shortfalls. Refinancing became structural rather than occasional. Short-term obligations were extended through new debt. Balance sheets expanded rapidly. Asset valuations relied on projected future monopoly income. Goodwill from acquisitions inflated book values. Opaque accounting practices concealed liquidity strain. Auditing standards were weaker than modern requirements. International subsidiaries were not uniformly examined. Currency fluctuations added additional complexity. Exchange rate movements affected reported earnings, yet financial reports maintained an image of reliability. Analysts lacked access to detailed contract terms. Investors saw summary statements. Detailed disclosures were limited. The empire's complexity discouraged skepticism. Size substituted for clarity. Kreuger personally controlled much of the information flow. Centralized authority reduced internal challenge. Corporate governance structures were underdeveloped. Boards often relied on Kreuger's assurances. The company's expansion masked internal fragility. Apparent diversification reduced perceived concentration risk. In reality, obligations were highly interconnected. If one segment faltered, pressure spread quickly. Hidden liabilities accumulated quietly. Off-balance sheet commitments existed. Some assets were later discovered to be overstated. The system depended on confidence in reported figures. Accounting opacity supported continued borrowing. As long as bond markets remained receptive, discrepancies remained hidden. Financial engineering replaced transparent reporting. The illusion was not built on a single false entry. It was built on structure. Structure concealed leverage. Leverage amplified vulnerability. The accounting system did not collapse immediately. It weakened gradually under the surface. The appearance of stability persisted. The fragility increased. The empire's strength was increasingly dependent on belief in its numbers. By the late 1920s, Ivar Kreuger was portrayed as a financial visionary. International newspapers described him as a stabilizing force in Europe. He was presented as disciplined and methodical. His engineering background reinforced perception of precision. Governments welcomed his capital. Politicians treated him as strategic partner. Banks viewed him as a reliable intermediary. Elite social circles amplified his stature. He cultivated relationships with ministers and central bankers. His presence at negotiations suggested credibility. The match monopolies appeared orderly and efficient. Bondholders associated his name with punctual coupon payments. Reputation functioned as collateral. Investors rarely demanded deeper disclosure. The scale of operations discouraged doubt. Prestige reduced scrutiny. Financial journalism of the era was deferential. Critical analysis was limited. The empire's international reach signaled competence. American investors trusted the Swedish financial system. Sweden was viewed as politically stable. The perception of national integrity extended to Kreuger's firms. Credit rating methodologies were primitive. Formal oversight of multinational holdings was minimal. Reputation filled regulatory gaps. Kreuger's personal brand substituted for institutional transparency. Media narratives reinforced his image as modern financier. He was credited with rescuing governments. He was portrayed as solving post-war instability. This narrative supported further borrowing. New bond issues were welcomed. Investors interpreted prior success as a predictor of future performance. Confidence became self-sustaining. Skeptics were marginal. Complex balance sheets were rarely examined publicly. The empire's structure relied on centralized authority. Information was tightly controlled. Internal dissent was minimal. The perception of mastery concealed structural strain. Reputation reduced the demand for verification. Trust enabled leverage. Leverage amplified scale. Scale reinforced trust. The cycle continued through the late 1920s. As long as markets were liquid, reputation remained intact. When liquidity contracted, reputation would be tested. For now, the image of the Match King remained secure. By 1929, Kreuger's empire had reached its maximum scale. Swedish Match controlled large portions of global production. Monopoly agreements covered numerous European states. Operations extended into Latin America. The corporate network spanned multiple jurisdictions. Outstanding securities had reached extraordinary levels. Estimates suggest obligations exceeding $2 billion in contemporary value. Bondholders were located in the United States, Sweden, France, Germany, and elsewhere. Interest payments continued on schedule. The appearance of stability persisted. Stock market optimism during the late 1920s supported expansion. Access to American capital markets remained strong. New bond issues refinanced older liabilities. Debt maturity profiles were extended. Financial statements projected steady profitability. Reported earnings justified dividend distribution. Governments continued honoring monopoly agreements. Revenue appeared diversified geographically. The empire's scale suggested resilience. Interconnected subsidiaries amplified reported assets. Cross guarantees reinforced bondholder confidence. Liquidity appeared sufficient. The network of obligations, however, was tightly interwoven. Cash inflows from one region supported payments in another. Refinancing depended on continuous investor demand. If markets slowed, rollover risk would increase. The system required access to external capital. In October 1929, the New York stock market crashed. Global confidence weakened. Credit conditions tightened gradually. Investor appetite for new securities declined. Banks became more cautious. Bond placements became harder to complete. Kreuger's structure relied on expansion. Without expansion, leverage became visible. Short-term financing pressure increased. Government borrowers also faced stress. Currency volatility intensified. Cross-border cash management grew more complex. The margin for error narrowed. The empire remained outwardly intact. Internally, liquidity became strained. Accounting flexibility masked immediate impact. Public statements emphasized stability. Confidence persisted into 1931, but the environment had shifted. The peak had been reached. Scale had magnified exposure. The next phase would test the architecture. By 1930, the global economic environment had deteriorated sharply. The Great Depression reduced trade and industrial output. Government revenues declined. Many sovereign borrowers faced refinancing difficulty. Currency instability increased across Europe. The gold standard came under pressure. Capital flows contracted. American investors became more cautious. Bond markets tightened. New issuances required higher yields. Kreuger's empire depended on continual access to credit. Coupon payments required steady cash flow. Monopoly revenues alone were insufficient to cover all obligations. Refinancing had become routine. As credit tightened, refinancing became uncertain. Short-term liquidity pressures intensified. Banks requested clearer financial disclosures. Auditors began asking detailed questions. Some government borrowers delayed payments. Exchange rate movements complicated transfers. Intercompany loans increased. Balance sheet entries became more strained. Reported liquidity remained optimistic. Actual cash availability was less certain. Confidence remained publicly intact. Privately, pressure mounted. Negotiations with banks became more frequent. Kreuger sought additional funding in early 1932. Efforts to secure emergency credit faced resistance. Lenders required stronger collateral. Market confidence weakened gradually. Rumors circulated regarding financial strain. Bond prices began to fluctuate. Yield spreads widened. The empire's leverage became more visible. Complex corporate structures made rapid assessment difficult. Investors relied on prior reputation. Creditors demanded transparency. The environment no longer favored expansion. It favored contraction. Without fresh capital, obligations accumulated. Liquidity management became urgent. The system had been designed for growth. It was not designed for prolonged contraction. Stress exposed structural fragility. The architecture that enabled expansion now amplified risk. The credit tightening phase had begun. The empire approached a decisive moment. In early March 1932, pressure on Kreuger's empire intensified. Efforts to secure additional financing had stalled. Creditors demanded clearer financial disclosure. Bond markets were no longer receptive to new issues. On March 12, 1932, Ivar Kreuger was found dead in Paris. The official report described a self-inflicted gunshot wound. News of his death spread quickly through financial markets. Trading in Kreuger-related securities was suspended. Bond prices fell sharply. Uncertainty replaced confidence. Without Kreuger's personal authority, control fragmented. Executives attempted to stabilize communication. Banks began immediate review of company accounts. Financial documents were examined in detail. Preliminary inspection revealed inconsistencies. Reported cash balances could not be fully verified. Some assets appeared overstated. Certain securities listed on balance sheets were missing. A large quantity of Italian government bonds was later determined to be forged. The discrepancy shocked investors. The empire's true leverage became visible. Liabilities exceeded previously reported figures. Intercompany guarantees multiplied exposure. The accounting system unraveled rapidly. Confidence collapsed. Creditors moved to protect remaining assets. Legal authorities initiated formal investigations. Bondholders faced severe losses. Stock prices declined toward negligible value. Governments reassessed agreements. Match monopolies were restructured or nationalized in some countries. The perception of stability evaporated. What had appeared as disciplined expansion was revealed as overextended finance. The collapse was not triggered by a single false entry. It was triggered by systemic opacity. The death of Kreuger accelerated disclosure. Without centralized control, concealment ended. Financial statements were revised downward. Loss estimates expanded. The Match King's empire dissolved within weeks. The illusion had depended on confidence and complexity. Once examined closely, it could not withstand scrutiny. The collapse of March 1932 marked one of the largest corporate failures of the interwar period. The collapse of Kreuger's empire sent shockwaves across continents. Investors in the United States faced heavy losses. Swedish banks absorbed significant financial damage. French and German bondholders experienced impairment. Latin American governments reassessed financial arrangements. Billions in securities were rendered uncertain. Confidence in international corporate bonds declined sharply. American markets reacted with volatility. European financial institutions tightened lending further. The timing intensified global instability. The Great Depression was already underway. The additional corporate collapse deepened uncertainty. Legal proceedings began in multiple jurisdictions. Receivers were appointed to manage remaining assets. Investigations uncovered falsified documents. Forensic accounting revealed forged signatures. Hidden liabilities were documented. Interlocking subsidiaries complicated recovery efforts. Some monopoly agreements survived under new ownership. Others were dissolved or renegotiated. Swedish authorities initiated domestic investigations. Reputational damage extended to national institutions. International trust in cross-border finance weakened. Investors demanded stronger disclosure standards. Regulators began examining bond issuance practices. Corporate reporting expectations gradually evolved. The Kreuger collapse became a reference point in financial history. It demonstrated the risks of unchecked leverage. It revealed vulnerabilities in multinational holding structures. It exposed weaknesses in bond market oversight. The losses were not limited to speculators. Conservative investors had purchased the bonds. Pension funds and savings institutions were affected. The damage extended beyond one entrepreneur. It affected international capital markets. The perception of guaranteed corporate bonds shifted permanently. Trust required verification. Financial engineering without transparency became suspect. The collapse reinforced the fragility of confidence-based systems. The empire had spanned continents. Its failure reverberated globally. The aftershock outlasted the company itself. The Kreuger collapse revealed a recurring structure in corporate bond fraud. The pattern begins during economic instability. Governments require capital. Investors seek yield. An intermediary offers both. The offer includes guaranteed fixed returns. The returns exceed prevailing market rates. Political partnerships reinforce legitimacy. Monopoly rights are presented as secure collateral. Cross-border expansion signals strength. Complex holding companies obscure leverage. Intercompany loans inflate asset totals. Financial statements remain opaque. Auditing standards lag behind innovation. Reputation substitutes for verification. Coupon payments reinforce belief. New debt services old obligations. Refinancing becomes structural necessity. Growth conceals fragility. As long as credit flows, stability appears intact. When liquidity contracts, leverage becomes visible. Bondholders reassess risk. Questions arise regarding asset backing. Disclosure gaps become critical. Confidence weakens. Market access declines. Without refinancing, obligations accumulate. Hidden liabilities surface. Accounting discrepancies become undeniable. The collapse accelerates. The trigger may be external stress. The underlying cause is structural opacity. The Kreuger empire followed this architecture. Guaranteed yield attracted global capital. State partnerships provided credibility. Financial complexity discouraged scrutiny. Centralized control limited oversight. The system functioned during expansion. It failed during contraction. The blueprint did not depend on matches. It depended on bonds. It depended on leverage. It depended on belief in reported numbers. Corporate bond scams follow similar incentives. Yield premium attracts demand. Complex structure hides risk. Reputation lowers skepticism. Collapse follows tightening credit. The lesson extends beyond the 1930s. Innovation can build industries, but financial opacity builds illusions. The story of Ivar Kreuger is not only about fraud, it is about systemic incentives. Post-war Europe required reconstruction capital. Governments accepted private intermediaries to secure loans. Investors accepted higher yields in exchange for perceived stability. Regulatory oversight was fragmented across borders. Corporate disclosure standards were inconsistent. Bond markets rewarded scale and punctual payments. Financial innovation moved faster than supervision. The monopoly agreements appeared commercially rational. The bond structures appeared modern. The accounting structures appeared sophisticated. Each element contained partial legitimacy. Together, they produced opacity. Opacity enabled leverage. Leverage enabled expansion. Expansion reinforced reputation. Reputation attracted more capital. The cycle required continuous refinancing. It required uninterrupted confidence. It required limited scrutiny. When global credit tightened after 1929, the architecture was exposed. The empire could not contract gracefully. Debt obligations exceeded sustainable cash flow. Hidden discrepancies magnified stress. The collapse revealed that complexity can conceal fragility. Corporate bonds are promises. Promises require transparent backing. When backing is unclear, yield becomes illusion. The Kreuger case influenced later securities regulation. Disclosure requirements expanded. Auditing practices improved. International coordination increased gradually. Financial history repeated similar patterns in later decades. Guaranteed returns during unstable periods attract capital. Political association reduces perceived risk. Complexity obscures leverage. Liquidity stress reveals structure. The Match King's empire spanned continents. Its failure reshaped trust in corporate finance. The blueprint remains relevant. Innovation can build industries. Financial engineering can mobilize capital. But when transparency declines, belief replaces analysis. Belief can sustain expansion temporarily. It cannot prevent contraction. The collapse of 1932 was not accidental, it was structural. The system rewarded growth without clarity. It punished opacity when scrutiny arrived. Innovation can build industries, but financial opacity builds illusions.